A very good afternoon to our guest of honor, Mr. Abheek Barua, our mentors, and all the members of Millennium MAMS present today with us. A brief introduction about our organization, sir. Millennium MAMS is a not-for-profit organization founded in 1993 by our mentors, Mr. Vishnu Dhanuka and Mr. Sanjay Bhuwania, with the sole motive of creating financial awareness and literacy amongst women. The organization has multiplied many folds and has touched lives of over 6,000 women till now, giving them an opportunity to build financial acumen. The curriculum imparts financial knowledge through the study of current affairs, business dailies, analysis of balance sheets, AGM participation, tracking of global economic trends, and factory visits. We have chapters in Kolkata, Mumbai, and Bangalore. We invite stalwarts like you to our forum to increase our bandwidth of knowledge and information and further use it for our studies. Coming to our guest of honor for today, Mr. Abheek Barua. He is the Chief Economist and Executive Vice President of HDFC Bank. He has been in the financial sector for 27 years now. Earlier, he was with CRISIL, Merrill Lynch, and ABN AMRO Bank. He has advised the Planning Commission, the RBI, the Finance Minister, and the Prime Minister. He has periodically been a member of a group consulted by the RBI Governor on monetary policy. He is a member of the bank's Apex Asset Liability Committee. I'm sure we all must have heard him on various TV channels, read his informative articles in the Economic Times, or heard him at various finance and economic conclaves in India and abroad. He was voted as the best rupee forecaster in India by the Bloomberg in 2016. So I guess this makes him the most sought after man today. I think all of you will agree with me. Mr. Barua was educated at the Delhi School Economics and the University of Maryland, USA. He publishes regularly in academic and semi-academic journals, and his paper on financial inclusion in India, 2015, was rated as the most widely read paper on the Social Science Research Network. Friends, these are the exciting times going on in India. The half-yearly report card of the Indian economy is out, and we could not have asked for a better time than today to meet Mr. Barua on this topic. India's report card is fairly good, and it seems like a very promising candidate. The economic indicators are showing what they should, but then to understand the impacts and the effects of these, we need someone like Mr. Barua to tell us more about them. So give a big round of applause to Mr. Barua. Welcome, sir, to our forum.
Thank you. Thanks very much. And thanks for the opportunity to speak to you. This is indeed an honor and a privilege. And you will notice that I was last voted Best Rupee Forecaster in 2016. 6 years have passed since then, and I haven't been voted the best. So don't, bet on my forecast for the rupee now. But be that as it may, I mean, you talked about the half-yearly report card of the Indian economy. I think that what is happening now, especially with the spread of globalization and the integration of financial markets, as well as the fact that what happens in the financial markets increasingly tends to impact on the economy. What I decided to do is talk a little bit about the global situation, because that has so much of a bearing on what's going on around the world. And I think what is happening today and all the volatility that we see, you've seen the Sensex crash yet again. I mean, it's become like a predictable pattern. It goes up one day, next day it crashes. And all this volatility, all this uncertainty is really what I would call sort of a tragedy of errors, a tragedy of many errors. One of them, of course, is the war in Ukraine, where I think Russia perhaps regrets its decision to get into this war. The West regrets the severity of the sanctions with which it tried to deter Russia. But I think the biggest tragedy of error or misjudgment really stems from what is happening to inflation in the West, in judging that, and the way it is being fought, because that has an enormous bearing on what is happening to things like capital flows into India, portfolio flows into India, FII investments, our interest rates, and ultimately our exports, of course, if you want to talk about the real economy, and ultimately would have an impact on both the global and the Indian economy. So instead, I agree that the report card now looks good. I mean, you have the numbers looking fairly robust, but I'm going to be a bit of a wet blanket and talk more about the risks going forward, the scenarios, rather than kind of entirely celebrate India's achievements. Of course, we are sort of standing out as an oasis of stability in the middle of this very, very turbulent and stormy times. But what lies ahead is really the issue. And I sort of begin with the proposition that we cannot be, unfortunately, one of the downsides of globalization is the fact that we cannot be delinked from what the rest of the world is doing, and that is very critical. So let me just talk, if you, Sakshi, if you will, please turn to the first slide, and this is. I think this is the real sort of one of the big tragedies of today's times, and this is the inability of the U.S. central bank, the equivalent of our RBI, to judge the kind of inflationary pressures that lay ahead when it was taking decisions in 2021. And if you remember, 2021 was the year in which markets were flying. The Sensex was going up and up and up. And a lot of it was being fueled by a lot of global liquidity sloshing around. So when there are a lot of dollars in the system, people chase all kinds of assets, including emerging markets, including the Indian stock and increasingly bond markets. So what the Fed thought, so let me just sort of give a little background or a context in which we are talking today. The US is looking at inflation rates of over 8%. The European Union is looking at inflation rates of over close to 9%. What kind of inflation are they used to? The average inflation level, or the level at the central banks there, the European Central Bank in Europe, the US Federal Reserve, they target, and people are used to a level of 2%, right? So inflation there is running at about 4 times what people are used to and what central banks target. So to draw a parallel with the Indian economy, we target an average level of 4%, but we are willing to sort of let it slip by 2% on either side of this 4% point, which means that 6% is the maximum tolerance that the central bank or the RBI is supposed to have for inflation. Today, our inflation is running at a little over 7%, right? And there are deep concerns, and if you read the papers, there are deep concerns about where inflation is headed, how we're going to sort of bring it down. But imagine the Fed's problem. We are just 1 percentage point or a little more above what our tolerance level is. The US Central Bank, the European Central Bank are at 4 times what they are supposed to tolerate. And this is happened because, when COVID struck, there were, of course, you were all somehow related to the world of business, and you would appreciate the fact there were a lot of disruptions in the labor market, disruptions in supply chains, and so forth. So what the Fed was saying till the middle of 2021 is that, look, all this is related to supply disruptions. This will go away. And, let's not tighten, monetary policy or raise interest rates. Just wait for things to get back to normal, supply chains to normalize, labor markets, people coming back to the labor market. And that's how they sort of viewed the inflation situation and the outlook for the next couple of years. But what they didn't realize, and we still don't understand what it is that is driving inflation so high, but they somehow, towards the third quarter of 2021, these guys started realizing, the Fed and to some extent the other Western central banks started realizing that this was not just one of those things that you can wish away. And this was getting to be a problem. So I think it's human nature that when you make, especially if you are as influential as the US Fed, when you make an error of judgment of the magnitude that I just described, then you kind of make up for it by going to the other extreme. So in this particular sort of meme, in the first quarter of 21, they were saying that QE is simply a way of saying a lot of dollars in the economy. A lot of dollars in the economy won't cause inflation, and some inflation, but it's going to be transitory. But today they have reached a stage where inflation is still running very high, and things are so bad, and their onslaught on inflation is so aggressive. They are raising rates so much, as you might be sort of reading in the papers, that to put it in some kind of a caricature, people in the US are in a situation where you might even, if your mortgage rates go high enough, you might even lose your home. But I mean, the best that we can guarantee you is that you won't starve to death. So you can see this, and this is something that is, as investors or people who watch the market, who educate people about financial markets or whatever. When a major entity like a central bank swings from one extreme, saying that no, we won't raise interest rates, to a point where they say that, look, we're going to tighten interest rates so much that the economy will lose enough momentum in order to bring inflation down, then you're left with no sense of direction in the financial markets. And that is exactly what is happening. And we tend to often say that the financial markets, well, let's not, I've heard that the Sensex is no indicator of what is happening on the ground. But the financial markets do reflect, the stock markets do reflect underlying realities. But the financial markets are not just about stock markets. I think one of the most important financial market, which we don't pay adequate attention to perhaps in this country, is the bond market. And that determines interest rates. And interest rates ultimately determines how much you will pay on your EMIs when you decide to buy, say, a new car in during Diwali, the festive season, or you want to buy sort of a white gold, or buy a house. So there is a very strong link between the bond market, the interest rate market, and the economy. And I would argue that the stock market is also sort of a measure of confidence. Hand on your hearts, tell me, uh, don't you sort of the day the Sensex crashes and you're sort of taking a decision about buying a new car, because this is exactly what is happening to me. The Every day that the Sensex crashes, I kind of look at I immediately go to one of these websites like Car Deco or Car Wallet and look for cheaper models, or think that maybe I should postpone this. This is formally known as the wealth effect in economics, that if your wealth is it diminishes, even if it's just paper wealth, it has an impact on your spending, your psyche and your attitude towards spending, and that again has a bearing on demand and the economy. So that's really what's going on. And if we just turn to the next slide, please, Akshi, if you could. It's The problem is that the Fed has been going crazy with interest rate hikes. They've done 3 hikes of 75 basis points, so 3/4 of a percentage point each over the last three monetary policy meetings that they have. The problem is that things are just not slowing down enough in the US. So if you are, as market watchers or investors or people who are simply interested in finance, if you're expecting the Fed to stop or to just talk in a more what we call a dovish manner, in the sense that go a little soft and say that, look, we've done our bit and things will cool off from now, and that 8% will slowly come down to 2%. We talked about report cards and data and so forth. The report card that the Fed is looking at is not particularly favorable for inflation. So what would bring inflation down? If you have higher unemployment levels, because then, especially in the West, and for those of you who are in business, if you know that if it's a tight labor market, you have to pay higher wages, and higher wages ultimately feed through to higher prices, because if you're paying higher wages, you want to sort of maintain margins, you're going to hike prices. So you would want the labor market to slacken a little. That's not happening in the US. One of the gauges that you want to be looking at is how consumers are spending. So if consumer spending is going down, right, it means that demand is slowly moderating, it's softening, and that would have a beneficial effect on inflation. It's still not happening. And that's the big problem that all of us across the world are facing today. On the one hand, we have the Ukraine problem and so forth, but you also have this problem of the US economy simply not cooling off enough to bring the 8% inflation anywhere close to the 2% level that they would ideally like to get to. And that, in a nutshell, is the problem with financial markets across the globe. And this is not just true of the US, it's also true of Europe to a degree. You're trying very, very hard, you're hiking interest rates. It's simply not paying off. And as long as everyone around the world believes that the US economy is still strong, inflation is still high, and uh, interest rates are going to be moved up and up and up, what will you do? You will buy the dollar, right? So there is um, a very, very strong preference for the dollar because the dollar simply offers better returns, right? Because if you buy a dollar bond today, right, it will give you a much higher interest than it was giving, say, 6 months ago. And that is one of the problems. The other problem, which I think we saw during, for those of you who remember the great financial crisis or any episodes, I mean, this is another, this is again financial literacy 101, that in times of when there's uncertainty and crisis, what do you move to? If you had the option here, you would move to, typically you would move to gold, right? That's also true of global investors. But despite the various, problems and the various criticisms of the dollar that we have seen, that the dollar is no longer the primary currency, and the US is losing its pole position as the strongest economy in the world. China is picking up, and China, the yuan will be the next reserve currency and all that. The dollar still remains the currency of preference, and dollar assets still remains a currency of preference when there is risk, right? So when there is acute risk in the system, people who are able to move their money around the world just seek the safety of dollar assets. And that's why you see the rupee today at 82.33. You see so much of a flight of capital into dollar. You see all the emerging markets kind of selling off. We are not getting any traction, any sustainable traction in our markets, despite the fabulous report card that Preeti started the session with, because there is so much risk, and the risk stems from one bit from the uncertainty, one bit of which I referred to. There are other sources of uncertainty, like oil prices, and perhaps Sakshi, you could just turn to the one to slide on oil prices very quickly. So the other bit is the oil price situation, which is actually adding to the inflation picture, the inflation momentum. And although this is a very, very detailed slide, I just want to kind of sense, draw your attention to the fact that really there are 4 entities who are critical here. Russia, right? So the war has stopped or reduced supplies from Russia to the Western world quite considerably. The OPEC, which is trying to make as much money as possible as long as prices are high, and they want to keep prices high. Europe, which faces a terrible, terrible crisis because of the shortage of natural gas and of oil, on which they're going to sort of embargo completely for Russia, in terms of sourcing from Russia. And of course, you have the US, which has strategic reserves. They sit on a lot of oil. They produce a lot of oil. But that is also dwindling, right? So in what is sort of muddying the waters in this kind of situation is the fact that the most critical thing, the new gold of the 20th century, oil, which still remains, despite all this business about renewables and everything, oil is still very, very critical to the global economy. Oil prices remain high. And I'm just going to sort of end my bit by talking about how, certain things are not working according to the textbook. And when things don't go by the textbook, people tend to freak out. That's when risk perceptions are high. That's when people fly to the dollar. And one of the things that you would expect typically in cycles where the global economy is being kind of, there are attempts to slow the global economy down. Central banks are raising rates. China has had a terrible experience with their zero COVID policy. So China's the big one, the second biggest economy, is also slowing down. So the natural, what would bring the system into some kind of normalcy would be for a critical input like oil to see a large decline in prices. When that does not happen, and that's because of external exogenous factors like taking Russia, the biggest producer of oil, off off the map of the Western world's sourcing, then you are in serious trouble, because some of the basic relationships that you are used to, right? Even if you think of yourself as a trader, right? If the global economy is slowing down, you would go short on oil. You would sell oil. That is not happening anymore. And that is sort of another factor that is adding or compounding the uncertainty all around. So I'm going to stop here, and I've sort of tried to give you a sense of what is going on. I really have no idea where this will, this will stop. There are two scenarios being painted. One, that the Fed kind of goes soft sometime around March 2023, and things become a little normal. The other is, of course, that the Fed, having made a mistake once, will keep on hiking rates, and they'll sort of actually break the world economy before they stop, which is the big fear that a lot of analysts, very famous analysts, people like Mohammed Al-Arian and others are talking about, that the Fed is just going completely berserk because it feels that it has lost its credibility altogether as an inflation fighter. The best that we can hope for, and this was happening in August and hopefully will resume again, is that we are standing out. We do have an inflation problem, but it's, I gave you the magnitudes. It's nothing compared to the West, right? Our fiscal situation is good. Business is good if the global economy does slow down, if there are so many interest rate hikes. The export sector will take a hit, but we do have a large consumption base. As you know, we are largely a domestic demand-driven economy. All the exports, for those of you who are in business, would know that exports have increasingly played a bigger and bigger role. And so it is likely that we will be seen as a mini safe haven, right? So you have the dollar as the big safe haven, and you have India as the little small safe haven where money will come back. And we do have a problem of financing our import bill, because we import so much oil, and for that we need capital. And that is one of the big sort of issues that is sort of bothering everyone today, and which is reflected in the depreciation of the rupee. Hopefully capital will come back. There will be, the fundamentals of India will kind of shine through, and we will be treated differently from other emerging markets and other asset classes. That's my hope. But everything is on the table, and it's a very difficult world that we live in today. And despite the growth rates, the strong growth, 7%, etc., all I would urge you to do is just keep an eye on the risks don't be too inward looking. Don't just look at railway freight data or GST data and get carried away. I mean, there is a lot of bad stuff, to put it very simply, happening in the world around us. And unfortunately, we cannot sort of run away from this bad stuff altogether. Let me sort of stop there and take questions. And perhaps I would also request Sakshi, who was our sort of expert on financial markets, to also pitch in and take some of your queries.
Thank you. Thank you so much, Mr. Barua. Here, I would like to request Nidhi Kanoi to come in to take this forward. She would take the question answers forward.
Good evening, sir.
Hi.
Hi, I'm Nidhi Kanoi. I'm the president of Mumbai chapter Millennium Ma'am, sir. It's really an honor to be sharing the same online platform with you. Sir, if you don't mind, I'll start with a question which I have jotted down.
I would prefer it if Nidhi, if I may call you Nidhi, if you
Yes,
all call me Abheek. I get very thrown off when people call me sir. So
Okay.
I often wonder who they are talking to. So yeah, please.
So, Abheek, what kind of public and private capex do you see in the coming few years? And do you think our private sector capacity utilization will be able to achieve this 80 to 90% to justify this capex? Also, what sectors do you see this capex coming in, both the private and public sectors? Sorry, Abheek.
Yeah, so I think there is a lot of public sector capex that is happening. I think there is a lot of activity happening in railways for a change. Roads and highways have been the sort of the buffer or the bulwark against economic slowdown, even in previous periods. So I think that's happening. On the private sector side, I'm not very sure, because I think I don't know about you, but I think all companies that were planning capex, and I think there have been very significant moves of the PLI and the prospect of China +1, etc. And there were capex plans which I, as a banker, was seeing till sort of the first quarter or the second quarter of this year. I mean, things like textiles, yarn, chemicals, and so forth. But I think confidence has been kind of shaken a little. So there might be selective capex in some areas. I mean, I think cement, there is some expansion going on. But I think the broad, the move towards a private capex recovery, I think has been stymied a bit by what has been happening around the world. And as people in the world of business, you would understand that you can talk about interest rates, all other things, growth, but it's really the uncertainty which plays such a role in major decisions that you take, like capex. And I think our capex cycle, is just to sort of reiterate a point I made, was being driven by, largely initial phases were driven by some of the export sectors. And there, I think there is a bit of a cloud, and I see bits of news which says that the textile units are, cutting down on the number of shifts, even the number of work days. So, and the cancellations coming both from US and Europe of orders is quite startling in some cases. So we will see some capex, but it will be very selective. But government capex is so, and in the other area, there are some areas in which capex is happening in a sort of a private, public way. Defense is one area where the private sector is stepping in. There are opportunities there for capex, etc. But it's not a broad-based story.
Okay, thank you so much, Abheek. I'd like to call Vasundhara Pasari from Calcutta, please. Vasundhara.
Good evening, sir. Abhi, so India envisions itself as a developed country by 2047, the 100th year of its independence. Sir, can we have your views on this, please?
Yes, I'm sure. I mean, I think we are on the right path. I would like to see this off. I mean, it's always darkest before dawn. We really don't know when the dawn will come in this particular phase. But having lived through the great financial crisis, and really sort of wringing my hands in utter despair and thinking that the world was coming to an end. By 2012, 2013, things had completely changed. So the perspective that I offered was sort of a short-term perspective in this broader, this longer scheme of things that you are referring to. It might get pushed back, our 5 trillion aspiration or whatever developed economy standards. It might get pushed back a little. But I think we are on the right path of getting there. And but having said that, we need to get a lot of we still need to get a lot of things right. I think logistics, social sector, financial participation, I think, which you are so closely associated with. We need domestic savings. I mean, look, we depend so much on global savings, and look where it's getting us, because it's, once it stops coming in, then you're kind of, floundering around for money. But we do have domestic savings capacity, but it's not fully utilized, especially, working with women in the financial literacy area. There is still such a lot of potential investable savings, investable in, real expansion investments that is still sort of lying under the mattress or under the pillow or in gold. So, yeah, I think but it's not going to be an automatic process. And I think we need to pay a lot more attention to things like health and education going forward. And, again, to be a wet blanket, one of the things we talked so much about, the demographic dividend, it really hasn't paid off that well. And because we really haven't supported the dividend with health and education. Fortunately, I think what I like about this government is that it is very, very strongly focused on some of these grassroots issues and implementation and delivery of on some of these social sector issues. And if they keep at it, we will get there soon enough. I wouldn't despair too much about this sort of current situation in a long-term perspective. But in a short-term perspective, I'd sort of hide under my bed for maybe a couple of years.
Thank you.
Thank you, Abheek. Sushila, can you please come in with your question?
Good evening, Abheek.
Yeah, hi.
Hi. How do you find yourself writing crime despite your occupation as a chief economist? What scares you more, writing columns or writing fiction?
To be honest, I like writing fiction more, but I think there is. Let me give you a slightly detailed answer to this. I think I find a lot of similarity between writing crime fiction and writing about the markets, because in crime, your entire plot can fall through if there are basic problems in consistency, which is a problem, I think, with the older genre of Hindi thrillers. There was that one little bit which didn't fit in, and that is where the plot rested. And you kept thinking, ye kahan se hua, ye kaise ho gaya? So that ye kaisa ho gaya is very important for the financial markets as well. You can get everything right, but if you get one bit wrong, and that is the bit that's going to challenge you and break your reputation as a forecaster or an investor or whatever. So I see this need to maintain consistency in plot and maintain consistency in thinking through financial markets and the economy. Very, very similar, and it's just as challenging. Although I do like writing fiction a little more.
That's some comparison, Abheek. Very interesting. Let me call Aarti. She's from Indonesia. Aarti.
Good evening, Abhi. This is Aarti from Indonesia. So,
Hi,
Abhi,
Aarti.
hi. So my question is that today we see the Indian industry as well as the capital markets predominated by three names: the Tatas, Adani, and Ambani. So do you in any manner see this to be a threat for the country?
Well, I would disagree with you. I think there is too much. Yes, they are in very, very major areas of the economy, but unlike, say, China or perhaps even Indonesia and some of the ASEAN countries, one of the greatest advantages of India is that we have a very large class of risk-taking entrepreneurs, and there is a long history to it. I mean, and we have communities here who are traditionally risk takers. You talk about people, the Marwari community in Calcutta, right? Enormous. I mean, we in this country we don't have enough respect for people who take risk and the ability to put their money where their dreams lie. But in the Gujarati community, the Chettiars in South India, and that has actually created an ecosystem of entrepreneurship which is spread across the board. And what I see, I'm from Kolkata, and I see the younger generation of the Kolkata business community, just taking things a step forward, coming from some of the best business schools and so forth. So I would disagree that it's, that it's just a Tata, Adani, Ambani story, unlike maybe say China, where I think the lack of entrepreneurship and an entrepreneurial culture had been at one point a big constraint, but we've never had that, right? Of course, the entrepreneurs have had to, because of external circumstances, have had to, manipulate things. If you had a very large government which was meddling in everything, you had to sort of see your way past that. But the fact is that we have a very large entrepreneurial base, and that is one of the biggest things. Again, I mean, you just look at the stock market. If you look at the Indonesian stock market, how many of the listed companies would you seriously be invested in? I would say that we would have a multiple of at least 50 compared to Indonesia in terms of listed companies that I can seriously be interested in. Maybe they will not give me returns anyway. And of course, I'm not going into stories like the IT story, the startup story, etc. Bubbles lie everywhere, so not everything is good. But I do believe that we have a very strong entrepreneurial class, and historically have had one. The Bombay Stock Exchange started in 1850, I think.
Yes, thank you. That's very pleasing to hear. Thank you.
Sure.
Thank you. Can we have Meghna next, please?
Yes, Abheek, I wanted to get your opinion on India's consumption story. who do you see as the real heroes here, the rural or urban, especially when we are trying to see from the equity markets, like what do you feel?
I'm going to, Sakshi has a lot of expertise on this, and perhaps Sakshi, would you care to comment on this?
Yeah, sure, Abhi, sure. So, I think that, there is the India consumption story is, of course, very different, when you look at rural consumers and when you look at urban consumers. But I think there is
Right.
scope for growth on both sides. What we have been witnessing, over the last few months, post COVID, and people have come back. Of course, the consumption recovery has been faster, perhaps on the urban side, especially in services, etc. But when you pick up, when you move away from the metros and you look at tier two, tier three towns, and also, the some of the indicators that we look at for rural consumption, those have also surprisingly been holding up, pretty well. Of course, from a very long term or medium term perspective, when we look at penetration levels in the rural sector, there, the penetration levels in a lot of consumer categories is still very low, which kind of suggests that as per capita incomes start rising in the rural side of the economy, there is, scope for further rise in consumption. Also, I think with pandemic, and something that we are noticing is that there is this move towards, getting used to the digital platform, right? Of
Right.
course, smartphones, etc. Penetration levels on that front have kind of picked up over the last few years. But even in terms of job opportunities and being able to work from different locations, I think these are some trends that are coming up, and I think we shouldn't really discount them or wave them off, because I think this kind of gives us a sense that the consumption story is going to keep becoming broad. Of course, right now, we are seeing that, perhaps the middle income or the upper middle income is driving the consumption story or the recovery in India. But once we have the lower middle income section or the low income section catching up in terms of per capita incomes, I think the real boost perhaps will come from there.
And I think what is also, just to supplement what Sakshi had to say, is that, I was quite surprised by the penetration of things like e-commerce in rural areas. Amazon during the pandemic was delivering to 99% of India's postcodes. We run a thing, we are part of a for-profit institution called the Common Service Center, which offers all kinds of services. They're now getting into rural retail. This is jointly done by the Ministry of Electronics and IT, MeitY, and we have a stake in it. The kind of rural demand and penetration that we are seeing uh, through the digital route has taken us completely by surprise. But that said, in the near term, I would be betting more on the urban story than the rural story. If you're looking at corporate earnings for the next few quarters, I think there are some sort of issues on the rural side, but that remains. It has so much juice left that if you just slice it the right way, there's a squirt of juice coming out. For instance, as a bank, we decided to typically rural lending used to be about agricultural crop lending, and banks were just very reluctantly in the last month of the financial year getting hold of some farmer and giving him a loan and so forth. But what HDFC Bank did, for instance, was to look at uh, the rural middle income and the upper income groups as a very, very robust borrower base. and we've reaped very, very rich dividends from that. So there is a lot of potential out there, and companies who are reaching there, I would, from a long-term perspective, look at them very, very seriously.
Thank you so much, Abheek and Sakshi.
I'd like to call upon Preeti, please, our president.
Hi, Abheek. Abheek,
Yeah,
now
hi.
that we have touched upon the topic of digital in finance, I want to ask you, how is this ONDC going to pan out, and how will it affect the banks like HDFC, and how are they going to participate in this ONDC thing?
Well, I mean, I think all digital effects, initiatives that are there, we will participate in. We have, taken part in most, digital initiatives that have been introduced. Our digital lending, etc., has gone up tremendously. We are working on our back-end system. So one of the issues on lending digitally is risk assessment, right? And there things like analytics, etc., play a very big role. And we are now getting to a point where some of the constraints of faceless lending and just having enough information to kind of categorize the risk of a particular borrower, we have reached that level. Some of the fintech companies started it, but the banks also participated in it. So I think both in terms of platforms and the ability, and for banks it is critical to assess risk, we are hitting a sort of a very critical point where both these things are sort of coming together. And I think we would be able to take advantage of any digital platform or initiative at a pan-India level that comes our way.
Thank you, Abheek.
Abheek, we'll take one last question, please, from
Sure.
Vaishali. Sorry, we'll call Jyoti Wadhwa. She was earlier in the queue.
Hey, Abheek. A very
hi.
different. Hi. I'm going to ask you a very different question today. If, with all your knowledge and your expertise, if you are the Fed chairman today, what two things you would have done, or what two things you think would have changed their economy in a better state?
I think I would have responded, and this is very easy to say in hindsight, and I agree, because
Yes.
the COVID created so much of a scare of economies completely going down the tube. But there were, warning signals. The housing market was overheating. The asset market, as you know, was going crazy, and all kinds of new instruments coming in. I would have started slowly hiking rates much, much earlier.
Yes.
And today, I would not, take things to an extreme and overcompensate for the mistakes that I made in the past. So these are the two things that I, as a Fed chairman, I would like to tell if I had the opportunity to tell Mr.
I'm okay
Powell.
with 26.
But I understand, the US has had
Everybody's saying, everybody's spending like, matlab, abhi karna hai to karna hai, nahi karna to nahi karna hai. That's all.
Please mute yourself, Zaneen.
See, you're spending 20 grand extra. Everybody is spending 20 grand more than they would have otherwise spent.
Please mute. Zareen.
I thought Zareen was asking a question or commenting on the Fed. So I was trying to figure out what, I thought it was kind of insightful. But sorry, Jyoti, I was saying that the US has a history of high inflation and the Fed going wrong in the 70s and so forth.
Yes.
And then they had to take very, very drastic measures in the 80s to get it under control.
Absolutely.
So it's not surprising that the Fed is getting a little hyper about things, but you just have to. Today, earlier in the 80s, you were not affecting the rest of the world. You were not affecting a small retail investor in Indore.
Yes. Yes.
Today, what you are doing is affecting, the NPS amount of a railway employee in Begusarai. So you have to be aware of your power and the impact that you have. And I think that is the problem with the Fed. The Fed is still very, very insular and internal, looks too much at the US economy. And that's the downside of globalization, but an internal focus in taking certain very key policy decisions.
Abheek, if you have a little more time, can we just call in Vaishali, please? One last question.
Sure.
Vaishali?
Good afternoon. Sir, now we were already talking about the rates. So I would just like, we've already had fairly two large rate hikes by the RBI. And the repo rate is also almost around 6% this year. So where do you see the demand actually getting affected by this?
I was reading an interview with Shanti Ekambaram of Kotak yesterday, and she was saying, well, till now it's kind of okay. It still hasn't hurt demand, but one more rate hike, things will start to change. Of course, the housing market will get affected. Any kind of leveraged market will get affected, and I think the reopening effect of things just being available, for instance, in cars where there was a semiconductor problem and things, we've seen a boost there. But now, if the RBI keeps taking rates up further, which we expect, because we just need to do that, otherwise the rupee will go to 90 or something. So if that happens, there's bound to be an impact on leverage spending. So wherever there is a leverage spending element, I would tend to be a little cautious. So, for instance, in the consumer space, I would tend to look more at consumer non-discretionary, the FMCG categories, rather than things like white goods or autos and so forth, or housing, which involves necessarily leverage and its associated costs.
Thank you so much, sir.
Thanks, Abheek, for answering all our questions. I'd like to call upon Krishma from Mumbai to give you a vote of thanks, please.
Good evening, sir. An investigative mind often identifies a problem and visualizes a solution. Steps to slow down the soaring inflation by India has made it the 5th largest economy in the world today. Unfazzled by the geopolitical factors, India's growth story has just begun. Just a thought, sir. Has India now become the land of the rising sun? Good evening, sir. Thank you for gracing our event from your busy schedule and shedding enormous light on the world inflation linked with global economies. I'm Krishma from Mumbai and would like to also thank our guiding stars forever, Dhanuka sir and Sir Bhuvanyap sir. Thank you, sir.
Thanks, Krishma, for those very kind words. And I'd like you to also give a vote of thanks to Sakshi, who was put this presentation together. And I learn everything from her. I'm just sort of I'm just a mouthpiece for her research. But thanks for the opportunity, and thanks so much. It's been a pleasure and an honor, and hope we can do this again.